years, 3.5 years. We are doing these webinars, and today is a 171 webinar. Participated more than 1 lakh people in our various webinar, which you have seen in our presentation on various topic. So sometime we tap our own back also, continuously doing this type of exercise. Friends, today's topic is very important and strategical, because always we try to do program on some topical issues, some strategic issues, some issues which are burning in the corporate world. So buyback is always a burning issue. It's a we used to call Sada Bahar topics. You can do anytime, because buyback, if you understand the completely its nuances, then every company will try to do this. So today, when buyback of security is a corporate financial strategy that involves capital restructuring and is reported by the company to achieve certain objectives, such as increasing earning per share, averting hostile takeover, improving return to the shareholders, and realigning the capital structure. These are the basic point when company understand this. But in the buyback, something is more is also there. The buyback strategy is crucial for both listed and unlisted company as well as private companies. Today, now we are seeing that so many companies are issuing ESOP, and then the unlisted company, when they are issuing ESOP, then how they will give benefit to the employee. So they do buyback. So that is come under the unlisted companies buyback, and that is also very important to understand. And because of that reason, the ESOP successes are there, because you have option of buyback of these ESOP from the existing employee. Typically, when a company has excess cash and its shares are underperforming, a buyback becomes an effective tool for creating stakeholders' wealth. Moreover, the market generally view buyback positively. That is the past cases and various cases which has taken place. Like, just take example of IT companies. They are continuously doing buyback on regular interval. The buyback of security, like any other corporate restructuring transaction, involves several financial and non-financial issues. The buyback process need to be structured in a way that address all the issues favorably. When we talk about the buyback, so it's not a question of that just buyback is a very small thing. You have to see 360-degree complete on all aspects. So the today's webinar, which we want to discuss, we want to cover following topics. Why opt for buyback? So buyback is there, but why you should do opt? Because it's not applicable to all, and it is applicable to whom. That is also a strategical point, because buyback should create value, not decrease the value. Then benefit of buyback to companies, investor, and shareholders. That is another aspects which you have to which we are discussing today. Analysis of recent buyback. That is also another aspects which we want to give the live point of view, that which all companies have come out with buyback and what is their impact. Reason for companies to undertake buyback at regular interval, because I just told you about the TCS and ITC, these TCS, and then other IT companies, they are doing continuously on a regular interval, they do buyback. Taxation aspects of buyback, that is very important. You, if you are planning to do buyback and without understanding taxation aspects, the buyback may backfire. So you have to understand the future of buyback. That is another aspect, another technical issues in buyback. Today, these are the topics which we will discuss. And for doing this, we have we have invited a very learned people for this program. And our program is like this, that first, Anjali Agrawal will discuss about the regulatory aspects and the process of buyback. Then we have Mr. R.K. Agrawal, who will discuss about the taxation aspects, who is a partner, Rakesh Raj and Associate. And then we have invited two industry person, Mr. Anil Jain from Director Corporate Affairs Cosmo Film, and Sanjeev Gemawat from GC from Vedanta Group. And both the learned speakers, they have done the buyback in their own company, and they have experience on buyback. So industrial aspects and what they have done and what is their view, we will discuss this issue. And then we have a question answer. The Manoj and Ankit will be there. Ankit will cover the unlisted companies buyback. What is the unique things we have to do? And then Manoj will cover the certain issues on a strategic point of view. So I extend a very warm welcome to our learned speaker. And I just want to tell about Mr. Anil Jain. He's a Director, Corporate Finance, Corporate Affairs, Cosmo Film. He has over 4 decades of experience in finance, account, and general management functions, having worked with Mawana Sugar, AF Ferguson, and National Mineral Development Corporation in the past. He holds the Commerce degree from Meerut University and the ICWN from ICWI. He is also a certified information system auditor from Information System Audit and Control Association, USA. And Mr. Anil Jain will join us shortly. I welcome him. Then we have Dr. Sanjeev Gemawat. He's a group counsel, Vedanta Group. He has around 3 decades of experience spanning through various industries like automobiles, real estate, hospitality, manufacturing, etc. He has been the earlier associated with Indian as well as multinational companies like Dalmia Bharat, DLF, and JCB. He has been honored to top General Counsel of the India in various prestigious General Counsel lists as released by Forbes, India, Business World, etc. He has been honored as one of the India's finest in-house counsel, the most influential corporate counsel and company secretary, and also inducted to the Global Hall of Fame for his contribution in legal ecosystem in India and the world. I welcome Sanjeev Gemawat. He is also joining us. Then I have a Dr. R.K. Agarwal, a partner, Rakesh Raj Associate. He's a chartered accountant, company secretary, and cost accountant. He is, other than this, he is MCOM, MBA, LLB, LLM, and PhD. He is one of the most qualified professionals in India. He has over 35 years of standing as a practicing chartered accountant. He has been member of Accounting Standard Board of ICAI. He was chairman of Company Secretary, Northern India Regional Council in 2003, and was also elected as a president of Hyderabad Income Tax Bar Association in 2000. I welcome Mr. R.K. Agarwal. He will cover the taxation aspects, and he's joining shortly. Then we have Ms. Anjali Agarwal, partner head, Capital Market Services, corporate professional. Then we have Mr. Ankit Singhi, head, corporate affairs and compliance, corporate professional. He will cover up the unlisted company part. Anjali will cover the listed companies part. Then we have Manoj Kumar, partner head, M&A and transaction, corporate professional. He will cover the strategic part, which he is handling when the transaction advisory work is going on. So friends, this topic of buyback, which we want to present before you, I just want to take few minutes to explaining that, because buyback, when we do, then everybody is seeing on the company's point of view, what are the advantages to the company, what are the advantages to the shareholders. And then always there is one question is coming, why buyback as compared to dividend and bonus? That is also a very important comparison. And all three options have some advantage and disadvantage. So when we talk about the company's point of view, so we can understand the financial ratio improves, flexibility is with the company, because dividend you have to give every year, but here you can give on regular without any year basis. You can give 1 year, then next year you can leave. Tax efficient system is also there as compared to dividend for shareholders. Excess cash, some company has the excess cash and there's no utilization. So you can use this by making your company more valuable, and that is directly because cash which is in the company cannot provide any valuation and it's a negative point. But when you use this cash, then financial ratio improves, company's capital structure improves. That is also, and that increase the market capitalization. Then another point is it gives confidence to the investor. Then control enhancement is also there. because when you reduce, because sometimes promoter is not participating, and in some aspects promoter are not allowed to participate. So by doing this, your equity is intact, and other people, other shareholders' equity is diluted, those who have participated. So your equity, your percentage is increasing. Employee compensation plan, which I told you that some companies are giving ESOP and they can work out. This is another strategy. Now, this is on the company's part. Investor point of view, they always see the potential for capital gain. Tax advantage is always there because this is a better tax efficient system than dividend. Dividend is more costly in the investor point of view as compared to buyback. Flexibility in participation, the investor, the shareholder can participate, and there is a possibility if there's a buyback and you are holding 500 shares, you can give 200 shares, 300 shares you can hold. That is also there. And shareholders value which increase because the percentage is reducing, then your value is also increasing. And then you can get indirect dividend by way of buyback, and confidence of India in their confidence in that company increases. So these are the point. But simultaneously, we have to understand that always there is a discussion that why buyback. And when we say buyback, then the comparison is always with dividend and bonus shares. So everything, when we do this, we see this effect on share price of as compared to all three option. We see tax implication, which is always favorable in buyback. And then we see impact on companies' financials. That is another aspect which we compare and see. Single to market. What is the message we want to give market? All three things are positive, but we have to see that whether buyback is better than the dividend and bonus. Investor preference is also is there in the buyback. Strategic purpose, we see comparison, and ultimately when we see what is the best option for capital appreciation, buyback; for regular income, dividend; for long-term growth, bonus. This is the indication of doing this. So today we will discuss all these points. We will discuss all these aspects, that why buyback and how it will be useful, strategical aspect, tax aspects, industry viewpoint, what people they have done the buyback, how we can understand, and what are the advantages. So these are the things which we will discuss. So friends, I will now request Anjali to give her presentation on the buyback. So the road should be clear and we can interact more effectively. Before this, I just want to announce our next webinar, that is 172 webinar on proposal towards ease of doing business for RIT and InvIT and non-convertible securities on 17th May. SEBI has come out two consultative paper on these two concepts, and we always try to do the program not after the law is passed, but we try to do program before law is passed, because by doing this, if there is something missing, the law can take a shape. So that is the one things we a professional can do, and the regulator is also asking because of this purpose. With these things, thank you very much, and I thank every participant, and I request Anjali to take up the next.
Thank you so much, sir, for giving the plenary session and explaining as to the modes of returning value to the shareholders. Any business which is running has a social responsibility as well, and the social responsibility comes with effect with the perspective that it has to return certain value to the shareholders. This value return can be in the form of, as you said, can be in the form of a buyback or dividend or a bonus of bonus of shares. So I just share my presentation so that we can discuss the contents. Is my screen visible, sir?
No.
No.
approach.
One second.
Now this is visible.
Thank you. So buyback of shares, as the name itself says, that it is buying the shares back from the public shareholders. Buying the shares back, obviously, when you are returning something to the public, it involves a concept of value. It involves a concept of what money should be returned to the shareholders when we are talking about the fund, because we have to do this value return from the funds available with the company. So we have tried, while preparing this presentation, we were thinking whether to cover the law and the regulatory parts on in the management's mind when they decide upon a buyback of equity shares or returning the value to the shares. So we thought of the latter one. We chose that buyback regulations, SEBI buyback regulations per se are very simplified that way. So we thought of making it a strategic PPT instead of covering the regulatory aspects. So meaning is buying back, the capital is reduced. Whatever number of shares the company buys back from the public shareholders, the same get reduced from my capital structure, as a result of which the number of equity shares outstanding in the balance sheet or with the shareholders get reduced. This is a brief trend of the buybacks that have happened during last 2 years. During the year 22-23, there were 62 buybacks, whereas 23-24, the number got reduced to 41. But interestingly, if we look at the buyback size, it increased from 21,000 crores in 22-23 to almost 2.5 times of 51,000 crores in 23-24. There can be a big question that as to why this number has reduced and why this amount has increased. So buybacks historically have been a concept of downward markets or sluggish markets or volatile markets. And last year, we have seen a very, very bullish capital market, and the market prices of the scrips were way high. So as a result of which the number of buybacks were reduced during the last 23-24. And because running market prices were very high, so there was a increase in the buyback size. April and 10th May.
Anjali, just check your voice. Anjali, your voice is cracking.
Getting to almost
Anjali,
350.
voice crack हो रही है.
It's cracking, sir. Just a minute, sir. Can I? Just a minute. Is it okay now?
It is okay now.
Yeah. So if we look at the 40 days of the current fiscal year, already the buybacks that have been announced is all to the tune of 350 crores. And as we talk, there are almost 3-4 other companies which have either announced their board meetings for the purpose of the buyback or are in the process of announcing them. So we can understand that since the present market comparatively is a volatile market, and the companies feel that this would be an apt time to do the consolidation in terms of returning value to the shareholders and buying back the shares, the companies are considering the share buyback. Now, if I am the manager, if I'm the management or board of director of a company, it is a very, very tough call for me as to how to return the value. Whether to return the value, how to return the value. If I'll decide upon a buyback, what would be the implications? What would be the signals that would be going in the market at large? So these are the decisions these are the dilemmas which remain in any promoter's mind or in any board's minds. So we have tried to cover each one of them. The first thing that comes to any management minds management's mind is whether to retain the excess funds that we have or to distribute to the public at large, fund utilization. Now, this decision cannot be taken on the basis of any one or two factors. This decision has to be taken on a very comprehensive study, consolidated study of various aspects which run in any organization. The first and foremost being the financial health assessment. I have to see, I being the management, have to see what is the fund availability with me, what is my financial health. Does my company, does my balance sheet allow me to spare off, to give away, say, 300 crores to the public in the form of a buyback? Or if I have outstanding debts with me, should I be paying those debts and utilizing my money and saving my interest cost? All these aspects are needed to be looked into. Then evaluation of the investment opportunities. Since buyback involves fund outflow, so obviously I have to see the opportunity cost of every rupee that is being spent. If I'm returning the 300 crores to the public at large, then what other benefits, what other investment opportunities do I have with respect to those 300 crores? If I acquire any land to purchase property, to manufacture, to start a factory, will I have better returns in my balance sheet, in my financial numbers, as compared to the non-financial numbers which I'll be getting out of the buyback? Then I have to analyze the market conditions. As I said in my beginning slide, that last year, comparatively, the number of buybacks were less. So we have to see whether the market will actually support my buyback. It should not happen that it backfires. If I announce a buyback at a wrong time, it may even backfire. So I have to look at the market conditions that are going on. Then understanding the shareholders' expectations. At any point in time in any company, there remains a variety of shareholders who have different expectations. For example, Pawan sir just now said that TCS, Wipro, these companies keep on announcing buybacks every year. Just a minute. I think there's still some issue with
Actually,
regard to
voice
my.
is cracking, so just change this.
Sir, is it okay now? Little any better?
Better hai.
Okay, fine. The video open. Fine. Yeah. So I was talking about the decisive factors to determine whether to analyze whether to come out with a buyback or to retain the funds in my company. So, in addition to financial health and the investment opportunities that are there, the next thing that we have to see is the shareholders' expectations from the company. If there are shareholders, if they are employees of the company who have been given ESOPs and the shares have been allotted to them pursuant to ESOPs, then there are different expectations they have as against the shareholders who enter the company at a particular point in time. If I invest in a scrip today at a running market price of 200 rupees and the buyback is announced at 300 rupees, I would be better off. I would be wanting to subscribe to to tender my shares in the buyback. But if a company came out with a IPO at a higher price, and now the buyback is coming at a lower price, I may not be too interested in subscribing to the buyback. Then accordingly, I have to see the shareholders' expectations. Then the tax implications. When we talk about tax implications, every value return method has a different tax implication. For example, in case of a bonus issue, it is only the long-term or short-term capital gain which would be arising in the hands of the shareholders. Then in case of a dividend, it will be taxable in the hands of the shareholders as per the person's slab rate. But in case of buyback, the taxability is in the hands of the company. It is totally exempted in the hands of the shareholders. So while deciding upon the methodology or the mode, whether we want to return value or not, we have to look at the tax implications as well. Then consideration of cost of capital. What is the cost of capital that I'll be using for returning the value? Risk management considerations I have to keep in mind, and alignment with the corporate strategy. My long-term corporate strategy, what exactly do we have in mind for the company at large? When we talk about the long-term strategy, we have to take a decision basis these factors. Ways of returning value, although we have discussed buyback, dividend, and bonus, none of them is a foolproof method. All have their own pros and cons, all have their own nitty-gritties and modalities to be complied with. A very basic comparative chart of what's the difference between all three of them. Bonus, we all know, is a capitalization of reserves. Dividend is giving of the reserves, and buyback also happens from the reserves. In case of a bonus issue, the capital will increase. If I come out with a bonus issue of 1:2, for every one share, 2 shares to be allotted, my capital will be, if existing, say 10 lakh is there, it will become 3 lakhs. Dividend does not impact my capital. In case of a buyback, the capital goes down. There is no cash outflow in case of a bonus, but dividend and buyback, yes, there is a outflow. Taxation, I've already covered. Now, this is a very important aspect to traceable shareholders. In case of a bonus issue, in case of a dividend, the shares in respect of the non-traceable shareholders or the amounts in respect of non-traceable shareholders have to be transferred to IPF. But in case of a buyback, there is no such impact. Any money which is not utilized for buyback remains with the company only. Market price adjustment, in case of bonus issue, there is a market price adjustment. In case of dividend as well, but in case of buyback, there is no adjustment, but then the market price definitely starts to impact or reflect the buyback decision. So can we say that these are alternate to each other? No, these are all independent corporate actions. Many companies do buybacks as well as dividends simultaneously. Many companies do only buybacks, and there are many companies who declare only the dividends, have never ever come out with any buyback. While buybacks are more tax efficient, they support the trading volume, they help in improving the ratios. But procedurally, dividend is a very simplified process wherein no intermediaries are needed to be appointed, no merchant banker is needed to be appointed. But at the same time, buyback draws a much more media attention as compared to dividend. So can there be composite fund distribution as well? Yes, there are many companies which declare both the dividends as well as come out with buyback. There are various reasons attached to this composite fund distribution decision. First, many a times companies feel that the tax impact would be distributed amongst the shareholders as well as the company. As I said, in case of a dividend, taxability is on the shareholders, and in case of a buyback, the taxability is on the company. So if I have to give a return value to the tune of 400 crores, I'll divide 200 so that half the taxability comes on me, the company, and half the taxability is borne by the shareholders. Signal of financial strength. There cannot be a better signal to the market at large than both the corporate actions going hand in hand, wherein instead of giving value, returning the value by only one method, the company is choosing both the methods to return value to the shareholders. Composite fund distribution caters to the requirements of both income-oriented as well as growth-oriented investors. Anybody who's looking for income generation, income approach, would prefer dividend, and anybody who wants growth, they would prefer buyback. And unclaimed funds will not get blocked in the IPF under the for the buyback. Now, another question that the managements many a time ask us, that buyback ultimately is leading to a reduction of capital. Then how do we say that it will lead to value creation? So the this is a very interesting equation. On one side, we are saying that EPS is increasing, but does EPS really is an indicator of value creation? EPS is just a notional number. It doesn't, buyback doesn't impact the share intrinsic value, but the true indicator of a buyback, true value indicator of a buyback is, most importantly, it gives a signal to the public that what the management thinks about the company's prospects. That means the company management is very, very positive about the company. They know that they would be able to survive whatever negativities come. In case anything comes, they'll be able to survive for next many years. That is why they are coming out with the buyback. Then that means that the cash utilized for buyback will translate into better performance over a period of time as compared to its present usage. Simultaneously, one has to see whether the cost of funds which are being utilized in buyback is more or less than the benefits being derived out of the buyback. If the cost is higher, then buyback will not be advisable. It will not be able to generate the value. But if the cost of funds utilized for buyback is lesser, then of course it will be able to derive value for the company. What would be the impact on the shareholders and their value? Because the number of shares get reduced, outstanding shares get reduced. So the dividend yield in respect of the people who remain as the shareholders of the company, it goes up. And ultimately, it leads to the total return, increase total return to the shareholders. Another thing which the managements many a time want to understand, what would be the sentiment, market sentiment when we announce a buyback news. A very interesting question that was asked us once was, does a buyback mean that the company does not have any any usage of the surplus funds it has, or is not doing well? Answer is a big no. Companies, there are many companies which have ample funds, surplus funds. They are investing, they are doing the capex as well as they are doing the bonus. They're announcing the buybacks as well. They have growth forecasts for their companies. That is why they can think of returning the value to the shareholders. And in a very, very crude language, only a person who's well off can think of returning back to the society. A person who doesn't know that 2 years down the line, what would be the status of their financial position, would really never think of returning value to the shareholders. Plus, the present regulations allow a company to buy back only up to 25% of its net worth. So in any case, not the entire funds are being used. It is merely a chunk, proportion of it that is being utilized towards the buyback. Another question is that these are some of the myths which are there pertaining to buybacks. Is buyback initiated or announced only to increase the promoter's holding? Here also the answer is a big no. Promoters consolidation may be one of the reasons behind announcing a buyback, but that's not the sole reason. Never the sole reason, rather. Buyback, as I discussed in my initial slide, buyback decision goes with various back-end factors and determining factors that are there. Then only a decision to come out with a buyback is taken. In fact, under the present SEBI norms, in a tender offer buyback, promoters themselves can participate along with the other shareholders. Is buyback biased in favor of any category of shareholders? The answer to this question as well is a big no. The buyback is a very, very unbiased corporate action. However, it may depend on the very intent of the company or the management as to why they decided to come out with a buyback. But by and large, it's an unbiased corporate action. In an open market or a book built offer, all public shareholders can participate. Their promoters are not allowed to participate. In a tender offer, even the promoters can participate. So buyback is like returning equal value, is giving equal opportunity to all the shareholders to be a part of the value being returned bandwagon. And we do not see it in any way to be a biased corporate action. In addition, SEBI regulations allow a reservation of 15% in favor of the small shareholders. So there also small shareholders are being taken care of. Now, what would be the impact of a buyback on the balance sheet, on the running market price, on the ratios? To take a very, very simple example, what would be the impact on my balance sheet? If a company does a buyback of 2,500 shares at a buyback price of 20 rupees, that is a buyback of 50,000. So my existing capital, which presently is 1 lakh rupee, would get reduced to 75,000 rupees. 10,000 would get reduced by 2,500. My reserves, which were there earlier at 50,000, would not be there anymore. I'll not be having any reserves because payment will be made out of, they are being utilized. To the tune of the nominal value of the shares, I'll be creating a capital redemption reserve in my balance sheet after the buyback. And my cash and bank balance, which were there earlier at 1,50,000, they will get reduced by the buyback amount. The total balance sheet size would get reduced from 1,50,000 to 1 lakh. This is a very, very simplistic example of the impact on balance sheet. What would be the financial impact on the ratios? Since there would be a reduction in assets, it would lead to increase in return on assets. Reduction in equity would lead to increase in return on equity. There would be an increase in EPS. It will improve the company's PE ratio. Because in whatever ratios the equity is coming as a denominator, they'll increase. Buybacks have improved the ownership concentration amongst the shareholders. And sometimes in every company, there are a set of shareholders who are activist sort of shareholders, if I may use the word. So buyback may be used as a strategy to give an exit to such people, wherein if a good price is being offered, they may feel that they'll exit the company through the buyback. On the running market price, there definitely remains a positive market reaction to every buyback news. We have seen many cases wherein when the moment the company gives an advance intimation of a proposed board meeting, from that day onwards, the market price starts to reflect positively on about the news, and the stock prices thus get supported. Now, market response, there can be, as I said initially, at any point in time, there are different types of investors that remain in any company. Existing shareholders, buyback, there would be buyback seekers, there would be new investors, there would be growth investors, there would be income investors. To explain this, we have tried to take the example of Paytm. Paytm, about 3 years back, came out with an IPO at 2,150. And last year, they came out with a buyback at 810 rupees. So any person who bought the shares, who took the subscription in the IPO, may really not feel inclined that as against an investment of 2,150, they would get only 810 rupees. But at the same time, even in this category, there may be people who would want that, okay, let me take an exit and utilize this 810 rupee to a better investment. Then buyback seekers who enter the company when they hear the news of the buyback, and take a exit in the buyback, they would be very happy with the entire events. Likewise, new investors who entered post IPO and are interested and they are happy with this buyback price of 810, they will also be happy to take an exit. Growth seekers may prefer to stay with the company and prefer not to participate in the buyback, whereas income seekers would want a dividend and then take an exit. As I said earlier, if not announced at a proper time, the buyback decision may even backfire. So we have to strategically see as to what is the apt time for announcing a buyback. Buybacks generally happen when the markets are low. The best example to explain this would be the COVID times. We saw the maximum number of buybacks during the 2021 years, because the companies were not very sure as to what will happen in the future. Plus, whoever had consolidation of holding in mind, they thought that these prices would be the best to do the purchasing. Then volatility in the market. If the markets are volatile, the companies, there always remains a confusion, a dilemma. So companies prefer to come out with buyback during the volatile markets. And even at the time of closing of the financials, annual financials as well as half yearly financials, we have seen a spurt in the buyback announcements. Now coming to little bit to the regulatory aspects of the buyback process, the modes involved, the process of buyback and the nitty-gritties involved. The most important to understand is the quantum that is permissible under the present SEBI norms. These limits are there not just under the SEBI norms, but as well as given in the Companies Act as well. For a buyback up to 10% of the net worth, the same may be done only by way of a board resolution. Shareholders' approval is not required. But if the buyback proposed is more than 10% of the net worth, a shareholder's approval by way of a special resolution is required. But the maximum buyback that can be done is 25% of the net worth. More than this is not permissible. That too, herein again, there is another cap. Maximum 25% of the paid up capital of the company can be bought back. In case of a buyback through the open market, the buyback limit is 5% of the paid up capital of the net worth of the company, which too is available only till 31st March 25. After with effect from 1st April 25, the open market buybacks are being done away with. So the modes permissible under the SEBI regulations are the tender offer and from the open market. Open market can be by way of two routes, via book building route or through the stock exchange route. As I said, stock exchange route is available only till 31st March 25. After that, the same will not be available. It is being done away with. Book build buybacks in India have not been practiced at all. There's not a single case through which has been wherein the buyback has been done through the book built method. Although in foreign jurisdictions, book built buybacks are a common methodology, but in India, it is not there. Pricing is very important to be understood from the buyback perspective. Under the tender offer, the buybacks are freely priceable and they are generally at a premium from the running market price, which may range from 25% to even 40% from the running market price. Open market, the buyback price is generally at a premium from the running market price, but the actual buyback happens on daily basis at the daily market prices. In the book built, a upper range and a lower range are needed to be provided by the company on basis whether the company is a frequently traded company or an infrequently traded company. And the final price is determined on the basis of the bids that are received in the process. So a brief on the timeline or the process flow chart. This is with regard to the tender route. I'll not be going into too detail of the flow chart, because these are given in the regulations in a much simplistic manner. We have to conduct a board meeting, we have to appoint the intermediaries, public announcement, escrow account is needed to be opened, letter of offer is needed to be dispatched. Till about last year, there used to be a requirement of SEBI approval for the letter of offer, but now that has been done away with. That now the letter of offer is just needed to be dispatched to the shareholders. The tender offer period remains open for a period of 5 working days. Then the payment to the shareholders happens, and the post-issue advertisement extinguishment of shares is the process. Open market is again almost a thing of the past. With appointment of intermediaries, board resolution, shareholders approval, depending upon whether it's up to 10% or more than 10%, public announcement is needed to be given. The company has to take a separate window from the exchange, and then the buyback is opened. Daily buying and selling and settlement happens in case of an open market. And then a board meeting in 66 days, the buyback is needed to be closed under the present norms. The post-issue advertisement is needed to be given, and extinguishment of shares. Likewise, book built issue is to be done. Book built issue remains open for at least 2 trading days. That's the major difference between the other methods and the book built method. Now, tax implications is a very important aspect in case of a buyback. Although Mr. R.K. Agarwal would be joining and he'll be taking up the subject in much details, but buybacks are taxable only in the hands of the company, and the taxable limit is 20% of the distributed income plus surcharge and plus cess on the differential pricing. So distributed income is the buyback price minus the issue price of the shares. Now, with respect to the issue price, there are many discussions that happen because as per the Income Tax Act, FIFO method of computing the issue price is needed to be taken. A very big question that under the present regime that comes is, with the demat of shares, how to determine the FIFO, how to determine the distinctive numbers, because now there are no distinctive numbers, but we have to follow the FIFO method. Then what would be the issue price if the shares have been issued pursuant to conversion of preference shares or loan or debt or debentures? Then what would be the issue price if the shares have been issued in a bonus issue? Likewise, if there has been a split of face value, then what would be the issue price? If the shares have been issued pursuant to a scheme of arrangement, then what would be the issue price? I would request, whenever Mr. R.K. Agarwal joins in, I would request him to take up these issues, and these being the prime focus points while the company is deciding for a buyback. That is how the entire entire thought process goes ahead, and the company decides to go ahead with buyback. Thank you. This is from my side. Over to you, Pavan sir.
Okay, thank you, Anjali. Thank you very much for giving a very nice presentation. The presentation was good, crisp, and to the point. So I hope that all the participants, they have understood the concept and all types of buyback process. Now, turn to our experts. Mr. Jain, Anil A.K. Jain sir is there. Jain sir, before going to the taxation aspects, you are a very learned professional and you have done buyback in your company. So just you share your industry view, why you have done buyback, what was the reason when you have decided. There must be so many options, because all big corporate, they don't decide only one topic, they decide all topics. They think that if they are doing buyback, so it means you must have cash in your company. Your other operation is not affected and it's a surplus cash. There's no planning for a future some expansion for which you have sufficient fund. So you want to incentivize the shareholders. So when you decided your buyback, or as a professional, when companies are doing this, what is the thought process on which corporates are working, and especially you, when you did your buyback, you have done? Over to you, sir.
Okay. Good afternoon, everybody. Thank you, Pavanji. Okay, I would like to share some of my views on the industry perspective of the buyback. One of the major consideration in determining about the buyback age, that if you are sitting it on an idle cash, no investors, no institutions like the companies to be sitting on the idle cash. Either you have an opportunity to invest it into your business and earn a good return on it. Okay. But if you don't have the opportunities, better return it to the shareholders. Okay. And shareholders do not like, obviously, the unrelated diversifications. These are not the things here. And we have seen it and analyzed it out. The companies which are having a large cash balance on their balance sheet, okay, it doesn't get reflected into their market capitalization. People don't apply any PE ratio. The multiple which you will get for the cash balance in hand is only 1:1. Okay. So if you are sitting it on an ideal cash, then there are options are either return it by way of the dividend, paid by way of a dividend, or paid it out by way of the bonus shares. Okay. But paid by way of the buyback. Buyback effect today is more cost tax effective compared to the dividend for most of the large investors' point of view. And therefore, the vote goes in favor of the buyback rather than paying it out the dividends into this year. Second consideration, of course, is that the current market prices of the shares, if they are low, it is into that, and the company management feels it out that we are not getting the right multiple into this, and therefore try and signal to the market that current prices are not up to the mark and they need to go down. So second reason, which I say it out, is that signaling effect to the market. Okay. So from the industry perspective, these are the only two issues which predominantly played a role in our deciding it or taking a call on the buyback. We have done 2 buybacks into the past, and both the times, primarily, we were sitting it on an excess cash. Okay, and when I call about excess cash, is not that if we don't have a debt on the balance sheet, because we believe that the company need to have an appropriate leverage. And after the appropriate leverage, if you have an idle cash, better get rid of it by sending it to the shareholders. Thank you. Webinar. So this is my views. Okay. Thank you, Pavanji.
Sir,
Yeah.
hello. Yeah.
Yeah.
Okay. Okay. So thank you very much, sir.
Yeah.
But tell me one important thing.
Yeah.
Is it right that when you have a excess cash, sir,
Yes.
then that particular time,
Yeah.
the cash is not identified as a good, and that you are also right that investor is not in a favor that you diversify in this. But today, the innovation and various other things are coming, like you are doing business, but your
Yeah.
business requires new technology, new innovation. ESG is also coming, so you have to do the sustainability. So
Yes.
I'm not going hindsight, but I'm going today's position when these things are having impact. Do you think that it will change your decision if you have a cash in the company you can divert into these?
Always the capital expenditure, minimum essential capital expenditure and new opportunity have always to be factored in, and they will get a priority.
Okay.
But within a particular time frame. See, another reason which I would like to share my thought processes is that these days in some of the industries, okay, investors do not like them to expand and invest in their existing businesses. Take the case of the petrochemical companies or oil refineries. The people don't want them to invest it out into the hydrocarbon. And
Okay.
these companies are generating it out huge cash. So
Okay.
what do they do?
Okay.
They distribute it by way of a dividend, and they find it out better alternative is to go for the buyback.
Okay.
Okay. And so that is one of the, again, motivating factor is, and to some extent it may apply to the industry in which we are in. Okay. So
Okay.
single-use plastics or these things like that, they are not the favorite of investors today. So you don't try and put the money into the same.
Why you have not
business.
given a higher dividend and you have chosen buyback?
Okay, at that time, and we paid both. Actually, we did both. We paid a dividend of 250%. Okay. And we also put it in this buyback because, as I said it to you, for the large investors, the buyback was more tax efficient than the dividend.
Do you think what decision you have taken, it's giving the result to you?
I think we earned the goodwill of the shareholders. Okay. And the shareholders were happy that the company has rewarded it to them. So for us, there was no other objective except that we were having the surplus cash and we wanted to share that with the shareholders. And that objective was very much achieved without it. Yeah.
No doubt, Anjali has said that dividend is a very simple process, but buyback is a long term and is requires lots of. So have you?
Yeah, but yes, it is true that buyback requires it out the greater time frame. And but well laid out procedures are there, and if you are in the hands of a good merchant banker, then nothing to worry much about that.
So have you faced any challenge, sir, in regulatory and other aspect? As because that is, I'm asking for the benefit of others. Sometimes
I
you
think
want.
we did not particularly face any of these issues. It into that the approvals, our merchant banker handled it well. It is into this, so no regulatory hurdles which were faced by us into this regard. Okay.
Okay. Okay. So, thank you, sir. I will. I think you have to go for a meeting. You please join back. So I will take various questions in. In the meantime, Sanjeev Jemawat ji has joined us. So Sanjeev, welcome for today's program. Sanjeev, you have work in various industries, various companies, and big companies, and you have handled the buyback also. So, what is your take on this subject, on this topic? Because you have just came late, I pose a question to Mr. Jain that when you are deciding, the first question comes in the mind of management: why buyback? What are other alternatives? And what are the advantages of other alternatives? So, first is dividend, one is bonus, one is buyback, or any other thing. So, what are the things which has come to your from management's mind, and you have given a presentation to them that, sir, these are the three options, and why you have selected buyback? By your selection, you can in a way giving answer to this, that why you have selected buyback, and so buyback is important. Over to you, Sanjeev.
Yeah. So, Pawanji, thank you very much. Thanks for having me in this webinar. Absolutely my pleasure and privilege while attending this. I heard you before when you were asking questions to Mr. Jain also, and I think very pertinent question. For some of the basics as far as this buyback philosophy is concerned, it has been always a controversial issue. It has always been a controversial issue because buyback has been considered as a mechanism or a tool of market manipulation. And so always people considered this as, the management of the company is doing it for certain basic objectives. But the fact remains, and the way in which I see this is that buybacks are largely being considered for two major reasons. One major reason is, of course, if there is a distributable surplus in the company that needs to be distributed, you need to have you have only two options, either by way of a dividend or by way of a buyback, and you need to distribute it. This is one simplistic argument in terms of distribution of this, or the use of buyback for distribution of the surplus money. But largely and invariably, organizations do not distribute amount by way of buyback only with this simple reason. Of course, tax rationale would always be one of the reason that yes, in buyback the tax impact is relatively lower as compared to distribution of dividend, and particularly with that kind of slab, it would always be higher. But then the two major reasons, the way in which I see is that whenever there is there's a whenever you need a correction in the share price, if your share price is not the true reflection in the market, you do not have any option but to correct this through this mechanism. And I think organizations go for buyback for the fair valuation of their shares, or to create the right market perception about their company. So this is one of the dominant factor in terms of taking this decision on buyback. The second dominant factor, which board or the management always would be considering, is that post buyback you get into a right kind of financial parameters as far as your financial statements are concerned, and that would help you in terms of raising further finance and all that. So I think it also reflects the financial health of the organization, and it corrects the share price also. It leads to a right kind of the financial ratios, and I think that also helps. Besides, I would say that the shareholders would always be considering two, three other aspects. And those two, three other aspects would be that if by doing this, they can create a long-term value in the company by consolidating the shareholding, or by correcting the prices. If they can have the long-term value enhancement for the shareholders and investors, I think that helps in terms of taking this decision of buyback. And fourth, I would say that buyback is one of the most simplest mechanism of exiting a shareholder. So from an exit mechanism point of view also, I think this is the best tool. So this is how I would be, describing this. I'm open in terms of other questions, Pavanji.
Okay. So, Sanjeev, just tell me what will be the today when you have done the buyback. So, what is the outcome? The outcome was the right which you have perceived or which you have thought, or it is different?
Well, Pavanji, as far as the specific company standpoint is concerned, outcome would always be the correct outcome, because if you have taken a particular decision considering certain parameters and factors in mind, and if you have achieved this, then you have achieved that right outcome. So there is no doubt about it. But then I will give a generic answer also to this, and that generic answer would reflect the issues which are revolving around taking a decision on buyback. And Pavanji, I think our audience would also be knowing this. The fact remains, and as I said initially, that this has always been considered as a tool of market manipulation until say 1980s. Most of the jurisdictions, this particular activity of buyback used to be an illegal activity. It was not permitted under law in most of the jurisdictions worldwide, for the simple reason that corporates used to use this particular mechanism in terms of putting some value to the shareholding, uh, and they used to take benefit out of that. Now, that is exactly the reason why when people criticize this particular tool, they criticize this tool for one simple reason, that post buyback, investigations do happen, particularly when certain class of shareholders, they are involved in certain activities in terms of buying and selling, or they are involved in certain amount of market manipulations. So those issues would always be getting raised. If they don't get raised at a particular point of time, immediately post acquisition, those issues would get raised even after a few years when the investigations in one form or the other happens, and at that point of time investigators also take these kind of issues in terms of their investigation, in terms of certain class of shareholders taking some action, taking certain advantages as far as companies are concerned. So I would say that from an immediate standpoint, no consequences, but then organizations normally I observe that they face these kind of difficulties during subsequent investigations. Raji, good afternoon.
Okay, okay. So, Sanjeev, just one very important aspect. When you did this buyback, have you faced any problem relating to regulatory aspects, some internal structure? That question I'm asking because as a corporate, as a professional, I want to do something. So I should take care of this part that is not comes as a surprise to me. So you have experienced anything or you have sailed through, but you realize that this point people are generally missing.
Well, Pawanji, frankly speaking, this is a fairly simple process from a regulatory standpoint, particularly when the parameters have already been specified. And if you are following those very parameters in terms of, whatever threshold of 25% or debt equity ratio and all that, then what is required is in terms of the filings and the particular, the compliances as far as regulatory framework is concerned. So I don't think that per se, this particular activity would lead to any complications in terms of not getting this through. Largely, organizations are successful, and that is the reason why you are noticing also in the last few years, most of the buybacks have been successful. No major hurdles, so to say. The only hurdles would be in terms of people perceiving it differently, but then to that extent, it doesn't matter so far as the approvals are in place. Yeah.
Okay, okay.
Yeah.
Any other thing you want to tell?
I would like to say one thing, and which I'm taking a point which you mentioned when I joined the webinar, and you said ESG and all that part. And that is what the concern which it appears to me that going forward in this, at the edge of this fourth industrial revolution, when we are talking about stakeholders' wealth maximization or stakeholders' capitalism, this particular activity of buyback appears to me an obsolete philosophy which is mainly concentrated and revolving around shareholders' capitalism. And so, from that standpoint, theoretically and practically, it appears to me that going forward, perhaps buyback would not be the right kind of mechanism, because when we talk about stakeholder capitalism, we are talking about the continuity of the organization, a purpose of the organization in terms of, for the posterity. And so the wealth which the companies generate, they should be using it for the further expansion and growth of the organization. And I think that is what one of the criticism which we are, discussing as far as the buyback tool is concerned.
Okay, okay. Because my point was there when the buyback, when you have a surplus cash, that time people were investing in a traditional industry, but today the technology and the sustainability that is there. So that was not there earlier. So today, in place of searching and investing, you can invest in your industry by doing, because cement industry, the technology, the mining industry where you are working, you have worked, they all are doing some innovation, and ultimately innovation related to sustainability is always with everybody. So
Absolutely.
that yeah.
And you are correct, you correctly pointed out, I think, and that is what the concern here is. Because the moment you talk about buyback, you are comparing it with the dividend, and you are mainly focusing on shareholders' benefits. You are not seeing the larger benefits of all the stakeholders, which today we are mandated to see under ESG framework or under the concept of stakeholder capitalism. And I think that is what makes the difference. And today's industry need lots of capital in terms of innovation, technology, and all that, and that needs to be captured. So I think that is the thought which is right now, getting discussed in the industry, and perhaps in the times to come, you will see more and more organizations investing in the company itself or in the growth areas rather than getting into this buyback kind of philosophy. Yeah.
Okay, okay. Thank you, Sanjeev. So
Thank
now,
you.
before going to R.K. Agrawalji, I have just quickly, because Ankit, he has to tell, because we have done the listed companies requirement. Ankit, just in a very crisply, you tell us the listed company requires so many things, but unlisted company buyback is also important, and so many companies are doing. And I have just told the ESOP, various companies are issued, they like a startup unlisted company, and they are doing buyback. So that is also coming unlisted company buyback. So what is the difference, additional thing which we have to do in the unlisted company?
Thank you, sir. Good evening, everyone. I think with respect to the ESOP buybacks, I think most of the buybacks which are happening in the startup industry is on account of the buybacks by the promoters or by the investors. So they are not actually following the buyback process as identified under Section 68. We have seen records of many companies who have previously done buyback of their shares, and we haven't found that they have undertaken any compliance under Section 68 by filing those forms under the Companies Act. So in most of the cases, their buyback was only limited to the buyback by the promoters or by the investors. Though recently we have advised one client where we have also worked upon in doing the buyback of ESOPs under the provisions of the Companies Act by complying with the provisions of 68 and doing all SH8, SH9 and every other stuff that was required, which typically generally doesn't happen, as I mentioned to you, but that was a specific requirement of the client that they want to do it in accordance with that. Coming back to the main point of the buyback of unlisted entities, while more so provisions in terms of compliance, a lot of things are same, but there are a couple of key issues like in listed companies, some I think debt equity ratio and some other things are calculated on a consolidated financial statement, which is not in the case of a unlisted company where everything is calculated on the basis of the standalone financial statement. Another major important point, which has been a point of dispute even ever since the Companies Act 2013 was introduced, is with respect to the amount of buyback, whether though the amount of buyback is in terms of 25% remains the same under the previous Companies Act and this Companies Act, but there remains a lot of debate in terms of how much capital you can buy back. Previously, if you read the provision under the Companies Act, there was a doubt that you cannot buy back more than 25% in any financial year. But if you read the current provisions, it gives you a sense that the intention of the law now is to restrict the quantum of the buyback in terms of 25% of the paid up capital and free reserves, including securities premium, not on the number. And there lies the difference in terms of interpretation. Many companies, professionals still take that view that 25% is still the um, upper limit in terms of the amount also and number of the shares you can buy, do the buyback. Though there are some precedents where registrar of companies have approved the cases involving buyback of number of shares more than 25%, but the total amount within the ambit of 25% of the paid up capital and fees. We also recently did a buyback where we have completed the buyback of more than 25% of number of shares, but in total, the amount remains within the 25% of the paid up capital and free reserves. Then there are also some views on the requirement of approval of SH8. We have seen in some cases, some I think registrars have taken a view that once you file an SH8, unless and until it is approved, you cannot circulate the offer letter to the shareholders to do the buyback. Though there is no provision under the act which says that SH8, when you file it, it has to be approved by the registrar of the companies. There is only a need of filing an intimation to the registrar of the companies. And so therefore there was also a view, but if you read the provisions of the Companies Act, they are very clear that they have to, you have to only file. So once you are done with the filing of SH8, you can also immediately complete the process of buyback by offering the buyback offer letter to all the shareholders. In terms of format, there is no specified format of per se offer letter. SH8 is a format for offer letter of PDF, which is in a PDF form. You can use that format as a format for preparing an offer letter, but there are many things that are not captured in SH8. So it is advised you prepare a detailed offer letter outlining all terms and conditions with respect to the process of buyback and other important issues. Another important point is that in case you're doing a buyback from your non-resident shareholders, then we have to be very mindful that when you're doing a buyback from your non-resident shareholder, it is equivalent to a transfer under the FEMA Act, and you are required to file a form FCTRS. Though it is not a transfer in complete sense because the share get extinguished, but under the FEMA provisions, they require you to do a FCTRS filing in case you are doing a buyback from non-resident. And in that case, you have to also keep in mind that when you are doing a buyback from a non-resident, the buyback price that you pay per share cannot be beyond the fair value as calculated by the merchant banker or the chartered accountant, which is not the case in case of a buyback by a Indian company for Indian shareholders. So, but if you have both Indian and non-resident shareholders, then it has to be, the price offered has to be same. So the buyback price will remain the highest of the fair value of the company. If there are only Indian shareholders, there is no requirement of any valuation under the Companies Act. Company can get the fair value done, or whatever the valuation they want to fix, they can fix it. There is no such requirement under the Companies Act to outline, to determine the manner. Though under the explanatory statement, companies are bound to give an explanation as to how they have fixed the buyback price. So these are some of the key issues which are connected with a case of a buyback in case of an unlisted company. If there are any questions by the participants, I can take that.
Okay, Ankit. Okay, that's all. I just want to ask one question.
Yes.
Can a private company do buyback for more than 25%?
I already replied that
That is a confusion, Ankit. Just give example when we say quantum. So what?
So quantum, for example, I can give you an example in terms of quantum. So I need to think about an example as to how
Okay,
it can be
you
done.
just
I'll think about an example and come back.
just give an example and do it. Just tell me, is valuation required for unlisted company buyback?
No, as I mentioned, not mandatory unless and until you are doing a buyback from a non-resident.
I'm just talking non-listed company. By valuation is required, and that is
from a non-resident, it is mandatory.
Okay. For merchant banker or chartered accountant?
It can be merchant banker or a chartered accountant as per the FEMA provisions.
Okay. Okay. Theek, Ankit, I will come back to you. So now the most important topic on the buyback, because when we do buyback, there are so many considerations, but the most important consideration is tax aspect. And if you ask anybody why buyback, so the question comes: the buyback is doing to compensate the shareholders, but simultaneously you are taking advantage of the tax also, because in India it is tax on the company, not the shareholders. So you company has to pay and shareholder can get, and there is no need to pay them. But when I was seeing USA and European countries, then they are both the places is a taxable. In India, it is changed. That is number one. Second is there are so many other aspects which are nitty-gritty, which we have to, when we are doing buyback, we should consider. So I'll request R.K. Agrawal ji for listed as well as unlisted. Just tell, because you have a wide experience of tax aspects and tax knowledge. Please tell us on the buyback, sir. Over to you, sir. RK. RK, your voice is, I think voice is breaking.
He's somewhere out actually. So probably there is signal issue.
Yeah. Okay. Anjali, in the meantime, RK is coming. I'm asking certain specific things to you. Do you think this buyback, which Sanjeev and AK Jain sir has told, there is this, because you are handling so many cases also. So have you faced some regulatory issues, some technical issues, which you want to communicate to the professional that they should take care of this part?
There haven't been any regulatory issues, but as I also said that buyback regulations otherwise are very clear and simplified. But in two of our cases, SEBI mandated that for physical shareholders, there were physical shareholders in the company, and otherwise they will not be in a position to even know that a buyback is coming. So special efforts were asked. We were asked as merchant bankers that you have to take care that they are informed of the proposed buyback. So we sent the letter of offers to their addresses. We even gave special newspaper advertisements so that any of the physical shareholders may get to know of the buyback, and they may also be a part of they may be able to participate in the same. Otherwise, no regulatory issues as such.
Okay. So for physical share, the nowadays when buyback you are doing, the SEBI and the stock exchange put restriction that you have to search these people, you have
Yeah.
to advertisement. So that is another challenge.
Hmm.
Okay. Now, is it mandatory to buy back from existing shareholder on proportion basis?
Under a tender offer route, it is done on proportionate basis. But under an open market route and book build, there is no requirement of proportionate.
Okay, when you manage this type of case, it is allowed to buy back shares in excess of the entitlement to buy back shares?
If there is any shortfall and a person applies for more, he can be accepted.
Acha, okay. Have you seen some backfire in the buyback proposal also?
There may be. We have to time and we have to take the decision in a very, very comprehensive manner after considering all the facts. It should not happen that we decide upon a buyback, tomorrow the price goes very high or the price goes very low. All those aspects have to be kept in mind while deciding a buyback.
Okay, I will come back, Anjali, with
Yeah.
various questions. R.K. Agrawalji, just please take your voice.
Yes, is it okay
Yeah.
now?
Yeah, it's okay, sir.
I'm
Please.
sorry, I am in some interior of Rajasthan, so therefore connectivity was a problem.
Okay, no problem. Now it's okay.
Yes. So far as the income tax provisions relating to buyback are concerned, these are quite tax efficient presently. We have seen so many listed companies regularly year after year, instead of distributing dividend to the shareholders, they are using the instrument of buyback of shares to the distribution of the assets or distribution of the profits is being done instead of by way of dividend, by way of buyback of the shares. Because
Okay.
in the case of buyback of shares, there is no tax applicable on the shareholder recipients. Rather, tax is paid by the company, and that too 20% plus surcharge. In the case of shareholder, if you are in the highest bracket, then tax rate goes up to 39%. So instead of 39%, shareholder making the payment of tax on dividend, if the distribution of profits is made by way of buyback of shares, then no tax on shareholders, rather corporates pay around 23% of tax. So effectively, the tax rate to the shareholders is less than 20%.
Okay.
So therefore, this is one instrument which is being thoroughly used by the corporates, particularly listed companies, for the purpose of distribution to the shareholders. And in the case of unlisted company, there is one more advantage because there is no concept of determining the fair market value of the share for buyback. The buyback price can be decided by the management at their discretion without any regulatory requirement of doing it at fair market value. So in this manner, that if you want to pay higher amount to the shareholders, higher price may be determined, and at the same time, you want to pay lower amount to the shareholders, lower amount may be decided, and it will depend upon the objective of buyback. In some cases, either of the system may be beneficial. In other cases, it may be other way around. So the provision presently is that corporate has to pay tax at a price which may be determined by the management in the case of unlisted companies. And in the case of listed companies, the price is to be determined as per the SEBI regulations. And the tax is required to be paid on the price at which buyback is being done minus the amount which was received from the respective shareholders. That is important. That if the shares were issued to the shareholder at face value, then whatever the amount in excess of face value, on that amount only tax is to be paid by the company. But if shares have been issued at premium, then the price at which shares have been issued, and this will be decided shareholder wise, depending upon from which shareholder you are having the buyback of the shares. So maybe that in total buyback, there may be certain shareholders from whom the shares have been issued at face value. From certain shareholders, you might have taken certain premium. From others, the amount of premium may be different, but the tax liability has to be determined according to the total value which is being paid minus the amount which was received from the respective shareholders. So again, that is also a situation which may create tax efficiency in certain cases. So therefore, this provision is quite beneficial, and there may be certain issues that how the price is to be determined, which has been received by the company, particularly in the case of amalgamation, demerger, etc. And for that, I am not discussing in detail. There is Rule 40BB under the income tax rules, which has prescribed different situations how the price is to be determined, which has been received by the company. Primarily, it is the amount actually received by the company, face value plus premium, or in the case of reorganization or demerger or amalgamation, etc., then the price which was received by the entity which has been merged or the entity which has been amalgamated earlier. That price has to be taken into account. As I said that the concept of fair market value is not applicable. The rule 11U and 11UA, which is required for determining the price in the case of transfer of shares, is not applicable in the case of buyback of shares. So therefore, neither for the company nor on the shareholders. The transaction may be at a price higher than fair market value or lower than fair market value, but none of them is going to be taxed either under Section 56 or under Section 50 of the Income Tax Act, because it is not in the nature of transfer of shares. It is just buyback of the shares, which is not covered within the ambit of the transfer of shares. Shareholders are not taxable. Again, this is a big advantage. So big HNIs are, the promoters who are controlling the company and having majority of shareholders. They are using this instrument to take the distribution of profits, so that their personal tax liability is nil and company pays tax on their behalf, and that too at a lower rate of tax. So thus, these are the provisions in brief. If there are any queries, you may please just ask for me.
Okay, RK, there are various questions are there on taxation. Whether the amount earned on buyback of shares is exempt from income tax?
Yes, in the hands of the shareholders, it is exempt. There is no tax in the hands of the shareholders. Company pays tax over and above the buyback price.
Okay.
And that rate is also fixed. That rate is also fixed. Irrespective of the bracket in which shareholder is falling, the rate which company is required to pay 20% plus surcharge.
Okay, and dividend, you have to pay higher tax.
Of course, if the individual shareholder, he gets the dividend, he has to pay, if he is in the highest bracket, 39%. So you get 100 rupees, you pay 39 rupees, you get differential amount only 61 rupees. And here in this case, you get the full amount from the company and tax is paid on your behalf of the company.
Okay. And sometimes what is happening, closely held company, they are giving salary to the directors or salary to the promoters, those who are managing company. But because salary is also taxable higher bracket, so they follow buyback system. Is it very prevalent?
I don't think that it is restricted only to the employees. Because in the case of the employees, it may not be possible that you pay only to the employees by way of buyback of shares, but rather the promoters themselves do use this instrument. Because if they are the majority shareholders, then they take out the profits in this manner and pay lower taxes.
So company is paying tax and they are getting the money. So that's
Yes.
so in a way, what you are suggesting, we were talking about the buyback, dividend, bonus. Third aspect is that closely held company use this tool as a to pay the money to the promoters also. Those were
Yes, this is the most tax efficient instrument at present.
okay. But RK, tell me, US and European country has both tax in the hand of company and the hand of shareholders also. And in India also there was a different tax treatment earlier. Why? What was the logic to change this?
So far as I understand, the present system, when shareholders are being taxed on the dividend, this is a better system, and worldwide this system is being followed. Dividend distribution tax, which was earlier in our country, was a unique tax, which was only in our country. Nowhere in other countries, dividend distribution tax type of provisions were there. But now, if the profits are retained by the company, then there is a lower corporate tax. The corporate tax is as low as 15% or 22%. If the distribution is made, then the recipient is taxed as per the slabs. So there is a equitable distribution that if you are in the lower slab, you get you have to pay lower tax. Sorry. If you are in a higher tax bracket, then as a shareholder you have to pay higher rate of tax. So I think from the point of view of the principle of equity of taxation, this is a better tax system, and which is now being followed from last so many years, and it seems that we have pinned down that this is the right way of taxing the dividend to the in the hands of the shareholders.
Okay, so it means that the company is paying 15% tax of the new entity, which is the tax for the new companies. So they have to pay 15%, and as well as they save the tax on the investor's hand. So ultimately, the government is getting only 15%.
Well, that is another aspect altogether. That corporate tax in India, we are having four kind of structure. 15%, which was introduced from 1st of October 2018 to attract foreign investment for the companies which are coming to India and establishing new units. That was the objective. In that process, even the domestic new companies are also getting the advantage of the 15% tax, and to make India as a tax competitive in comparison to other countries, this provision was introduced, which was initially up to 31st March 22, but it has been extended every year. Now it is up to 31st March 25. It has been extended till that date, and maybe in future also it may further be extended. But apart from 15%, that is applicable only for the new manufacturing units which are not being established by way of restructuring of the old units. Then we have 22% regime, 25% regime, and 30% regime. So we have four different structures, and depending upon the corporate structure in which you are following, or the company size which you are falling within, the tax rate is applicable as a corporate tax. But so far as the distribution tax on dividend is concerned, it is uniform to all, because it is taxed in the hands of the shareholders, and it depends upon the shareholder that in what bracket you are. You may be in 0% bracket, 10% bracket, or 20% bracket, or 30% bracket plus surcharge, etc. So highest bracket is 39%, lowest bracket is 0%. So now depending upon the shareholder. So small investors who are in lower bracket have to pay lesser tax, but promoters or the persons who are in higher bracket, they have to pay higher tax. And that's why those persons who are falling in higher bracket of 30%, 35%, 39%, they are using, if in collaboration with the company, this instrument of buyback, particularly like big company like IT companies like Wipro, like Infosys, you might be see every alternate year there is a buyback of shares.
Okay. RK, whether the loss incurred on buyback of shares can be adjusted against capital gain?
No, because in the hand of shareholders, neither it is taxable nor the loss, if there is any, can be set off. Because,
Okay.
for example, if the shareholder has bought the share at 50 rupees per share and in buyback he gets 80 rupees, the 30 rupees is not taxable. And similarly, if he gets 20 rupees, then the loss of 30 rupees may also not be allowed to be set off against the other incomes, other capital gains.
Okay. What is the tax implication for unlisted companies? Any different view on this?
So same tax structure for listed or unlisted companies. There is no difference.
Okay.
The only thing is that in the case of listed companies, as per SEBI rules, fair market value has to be determined for buyback of the shares. But in the case of unlisted companies, there is no requirement of determining fair market value. Company may decide at any price they may decide to buy back the shares.
Okay. Buyback price not taxable in the hand of shareholder. Please discuss the impact of section 14A of income tax in the hands of shareholder. Disallowance of expenditure incurred in relation to income not included in the total income, and section 8D method for determining amount of expenditure in relation to income not included in total income.
Because when the amount is not taxable in the hands of the shareholder, then any expenditure incurred relating to that income will also not be allowed.
Okay. Okay. Is valuation under 11U is applicable in transaction of buyback of share?
No, it is not applicable. No fair market value is required to be determined as per Rule 11U.
Okay. Okay. Which valuation method should accepted as per income tax law for buyback of shares? Is at book value buyback of shares is acceptable in income tax law for unlisted company?
There is no provision under the Income Tax Act, as I am repeatedly saying, that in the case of buyback, it is the discretion of the management at which price they may decide to buy back the shares.
Okay.
Under the Income Tax Act, there is no regulatory provision. There is no section 11U applicable. There is no requirement of determining the fair market value. Company may decide at their discretion at what value they want to buy back the shares.
Okay. There's a different twist, but what you are saying is if there is a different view, just tell for unlisted company, which valuation method is most acceptable as per income tax law for buyback of shares? While doing valuation for purpose of buyback and amalgamation, will it be okay valuation of shares done at intrinsic value, keeping in mind that ultimate beneficial owner is all the companies are common?
As I said, that it is the discretion of the company. So therefore, if they want to buy back the shares at intrinsic value, they can do it.
Okay.
If they want to buy back the shares at book value, they can do it. Because there is no restriction. There is no provision in the Income Tax Act which regulate or which ask you to determine the price for a buyback.
Anjali, loss-making company can bring out value buyback?
So no restriction under any of the norms, but we have to pay out of the net worth. So there has to be a positive net worth. We need to have positive reserves.
Okay. RK, for loss-making company, is any method of valuation or it is also not required?
If, as per Companies Act or as per SEBI rules, if a loss-making company is permitted to make the buyback of the shares, then the tax provision would be the same for even for a loss-making company also, because the company has to pay tax at a price which has been determined for buyback minus the amount which has been received from the shareholders.
Okay. Do assets and investment need to value at current market price or fair value, particularly fixed assets, property and investment in share of group company?
Again, we are getting the same question because I mean, this is all required when 11U is applicable. That you have to see the market value of the assets. But in the case of buyback, you can determine the price as per your decision of the management, but there is no norms, there is no restriction under the Income Tax Act so far to regulate the price of the buyback.
Okay. Mr. Ankit, this question is for Ankit. Instances of buyback by promoter without compliance of Section 68. Kindly explain on what basis.
Without complying 68, I didn't get the question.
No, have you? He has understand instances of buyback of promoter without compliance 68. You are
How?
not. No,
No, no. So I think what he was trying to understand that when I mentioned that ESOPs are being bought back by the promoters as a tool of buyback. So what I was trying to say that most of the startups, when they say they are coming up with a program for buyback of ESOPs, in all those cases, the ESOPs are generally bought by their existing investors or the promoters, just like a normal buy and sale process. It is not a buyback process under the provisions of Section 68 of the Companies Act. Though they say it as a buyback, but it's not a buyback under 68.
Okay. Okay. I think this question is for Ankit and Anjali both, but Ankit, buyback is not closed. However, the initial step of Form SH8 and Form SH9 are approved. Further offer price also closed, and SH11 is not filed yet because shares are in demat from an RTA is delaying for destroying the share certificate and confirm too. Now, company wants to raise next round of our query is, can we file SS7 and PS3 for another round of funding? And later, after filing PS3, can we file SS11? Ankit.
Yes, you can do that. There is no bar in doing any fundraising from other kind of securities. So if you're doing an equity buyback, you cannot definitely raise a equity fund for next 6 months. You can do a fundraising from other buyback from other sources of like preference shares. So there is no such linkage between this ongoing buyback not being completing and you being doing a fundraising to preference shares. And first of all, the day you make the payment, it is deemed that process is completed. Rest all the formalities with respect to just filing with the register of the companies. So even if SH11 is pending, you can do so.
Okay. In respect of the public unlisted company, equity shares should be in the demat form.
Yes.
Okay. Can a private company come up with another round of funding separate class of shares when buyback is not yet closed? SH8 or 9 already approved, and if yes, will there be any issue in the filing form SS7 or PS3 before filing SH11? It's same question, I
I
think.
have not, well, it's same. I have not dealt it with practically, but I don't foresee any challenges.
Okay.
If it is a different kind of a share.
Anjali, when there is a buyback is going on, so is there any gap between the one buyback to another buyback?
You can do the buyback on the basis of the previous year financials. So in a year, we can do only one buyback. But Ankit, answering to the query that you were answering the earlier query, under the Companies Act and under the SEBI regulations as well, no fresh funding, no
Of same
fresh
kind.
infusion of same kind. Yeah,
Of
yeah,
same
right.
kind.
Okay. Okay. Equity
Acha,
to
well,
equity.
Ankit,
Yes, if there
Yeah,
is any more query from me, otherwise I have to leave.
Acha, okay. Whether the buyback limit amount computed in inclusion of buyback tax amount?
Generally, it is not. We have seen.
It is
No, it is not.
excluded.
It
It
is
is
excluded.
excluded.
Tax is paid over and above buyback price.
Okay.
Yeah.
Is it the tax in case of buyback comparable to capital gain tax? It is similar to the transfer of shares, whether instead of third party, the company is buying shares?
Sir, it cannot
So
be a
it is,
transfer. RK sir can better answer. Yes, sir.
because this is not a transfer, so it cannot be equated with the capital gains tax. Rather, this is a separate tax which is imposed on the company, that in case of buyback, you have to pay the tax on the price which has been received, the price which has been determined for buyback minus the price which has been received from the respective shareholders. On that amount, company is required to pay the taxes. So it
Okay.
is a tax liability on the company, not on the shareholders.
Okay. Section 56(2) of the Income Tax Act will attract if buyback is below market value of unlisted shares?
No, it will not be applicable because it is not a transfer of shares. So neither in the hands of the shareholder nor in the hands of the company there is any implication of Section 56.
Okay. Okay. Arkit, a few questions related to tax thing. For companies, no dividend distribution tax and it's improved financial metrics. For investor, capital gain versus dividend tax, it is always beneficiary. Tax deferral is also there because you have to pay tax when you will sell the shares. So the point is that what you foresee in future about this buyback tax law is that will they change anything or something new will come or it will continue like this?
Because so far as I understand from the efficient and proper income tax policy perspective, so far as the dividend taxation is concerned, I think it is quite a stable policy and it is internationally followed and practiced policy that dividend is being taxed not in the hands of the company but in the hands of the shareholders as per the tax bracket in which they are following. But so far as the buyback is concerned, I find that it is quite tax efficient in the hands of the shareholders presently. Maybe in future, government may bring certain regulation to, either to determine the fair market value for the in the case of the unlisted companies also on which tax is required to be paid, or maybe some tax rate may be increased in course of time.
Okay. Last two questions to you. How do tax implication influence a company's decision to choose between buyback, dividend, and bonus share?
Because tax is one aspect. That in the case of bonus, there is no distribution. The funds remains with the company. It is only the capitalization of the reserves. That is one point. Then in the case of dividend, there is distribution. But you cannot keep on doing buyback always in lieu of dividend. So dividend along with buyback, people are following the policy that sometimes dividend is regularly paid at a lower rate, and to compensate further to the shareholders, certain companies are adopting the buyback. But this is not the only objective. That distribution of profit is served by buyback. There are certain other objectives which may be served, particularly in the case of unlisted companies, and tax planning can be done. For example, if you want a higher amount to be distributed to the shareholders, then instead of dividend, you give by way of buyback, determining the higher price than fair market value, and company pays only 23% taxes. At the same time, if you don't want to pay the taxes but restructure the shareholding, then maybe that you pay lower amount to the shareholders, restructure the shareholding the manner in which the company decides or company requires, and no taxes are or very lower taxes are paid by determining the lower price of the buyback. So it will depend upon the objective, how planning is to be done from the point of view of the corporate and either the listed or unlisted companies. It depends that what is the objective.
Okay.
But there can be different objectives which can be served. Restructuring of the shareholding, then there can be, tax saving, the distribution of profits by paying the lower taxes. So many different objectives which are served.
Okay. Arke, last question to you. Tax policies are changing always. And this is a statement. Just tell me, is it correct? Change in tax policy can significantly impact the attractiveness of buyback. For example, if capital gain tax rates were to be increased significantly, the advantage of buyback over dividend could diminish. Is it correct?
No, capital gains tax is applicable in the hands of the shareholders, and buyback is done by the corporates. If capital gains tax is increased significantly, then the advantage of buyback will further increase. Why it will diminish? Because presently the shareholders are required to pay capital gains tax or dividend tax in their personal hands. Company is paying on buyback, company is paying the taxes. If the rate in the hand of shareholders is increased, the instrument of buyback will be more used.
Okay. Okay. So RK, I think thank you very much because you are not in town, you are in remote area. So thanks for giving all answer. I can continue with other questions to other speakers. Thank you very much. You can drop
Thank
with.
you. Thank you, Pawan. Thank you, everybody.
Okay. Anjali, in case of listed company, if the audited accounts are more than 6 months old, can we take into account limited review
Limited review, yeah, we can take.
or have to go to audit of the
No,
accounts?
we can take limited review results.
Okay, the gap between one buyback to another buyback is 12 months.
Sorry?
One buyback to another buyback is 12 months.
Yeah, it can be.
Okay. So in case of buyback of the shareholder is a NRI, which he shifted to Dubai, he has on status of NR, as he was not in India for more than 120 days, but has bank account in India. Does file of FC TRS is required, Ankit?
Nope.
Why?
Because the shares, when he purchased the share, he was a resident. The consideration will also be paid to his Indian accounts. So in that case, it will not be required.
Okay. Since there is a restriction on no new equity shares during the pendency of buyback, would this apply to ESOP grant issue also?
Pardon, sir?
No, that's exempted. ESOP
Uh,
grant during the
Okay, yes, that is
period.
the. But sir, all
Exempted.
earlier obligations are allowed.
Okay.
Sorry, even grant of options are also allowed.
Okay. Ankit, the questions of the SS form people they were asking. So they are saying ROC is not approving the buyback if valuation report is not attached.
I don't think, sir, ROC legally the section mandates any valuation.
Okay.
So you can submit necessary clarification.
Ankit, Anjali, both. Whether CCDs can be brought back?
For a listed company, if there are any convertible securities, the company cannot proceed with buyback. The same has to be first converted into equity and then the buyback can be announced.
No, but I have a CCD. Can do buyback?
Of that CCD?
Yeah.
No. As yet
Ankit,
to
for
see any
unli-
such cases.
Sir,
But-
specified securities have been only defined as ESOPs and other securities as notified by the central government. So any other security has not been notified apart from ESOPs.
So CCD cannot buy back.
There
Okay.
is no provision as such as of now.
Okay. Teammate is there. So this big question. In family run business, I want to reduce number of shares holder. I will take buyback 100% of some shareholders. Is it okay? But you can't take some of the shareholders.
No, you have to plan it accordingly. If there is under subscription, any shareholder wants to tender more shares, which might result in his shareholding going down to nil or as a zero, then it can be looked into from that perspective.
Okay, after buyback shareholder come down to less than 20, I want to convert to LLP. It is okay for a small company? I don't think it's any problem.
I don't see any problem is there.
Can I take back 25% every year? 25% will be original capital plus reserve or reduce.
You can do a buyback every year after a gap of 1 year.
So 25% I can do.
Yes.
Only thing is I have to take board and shareholder approval.
Yes.
Is it necessary to get demat before a buyback?
Yes.
Unlisted also? Listed is
For
there?
public company, unlisted public company, as per the rule 9, it is required that promoters and all other shares have to be in demat.
And Anjali, yours? Listed
In case of listed companies, these corporate actions are permissible. Physical shareholders can also tender in a delisting, in a buyback, in a takeover offer.
Ankit, then why? But it is allowed in a delisted, listed company, the physical share.
Sir, in listed companies also, unlisted companies, shareholders can tender shares in physical. The only thing is that existing promoters and directors and KMPs, their share have to be in buyback in demat form before they proceed for the buyback.
Okay.
I'll see the rule. Anything else?
Anjali, how does management know that share market price correction is required? Does this mean the share price is overpriced in market and need to be reduced, or share price is underpriced and need to be?
The other way around. Other way around, if we feel that the value of the share should be 100 while it is being traded at only 75, then there is a time to go in for buyback so that the price gets corrected and the price is supported.
Okay. I asked the question, can a loss-making company do buyback? So you are saying loss-making company can do buyback. There's no restriction. Only thing they should have a net worth. So
Yeah.
can you tell me how much net worth should I have?
No,
Uh,
they can
Yeah, Ankit.
no, they can do a buyback from securities premium. Otherwise, so
Yeah,
it's not
yeah,
possible to do
they can,
a
yeah,
buyback.
they can.
Okay. Okay. Now, I have a share, the company has come out buyback and I have not applied for the buyback. Okay. So, and after some time, I want to apply. If the issue is closed, you cannot get anything.
No.
Okay. For physical share, you are saying, is there any provision that physical share they will keep for shareholders? The buyback is there. There is a, say, 80 shares is demat, 20 shares are physical, and you are bringing out buyback of 10%. So for 80%, the 20%, two shares, they have to keep it separate, or what is the process?
The physical shareholders have to contact their broker and the share certificates have to be sent to the RTA to be eligible to be accepted during the offer period.
Okay, otherwise it will not. Okay.
Otherwise, if they are received post the offer period, they will not be accepted.
Okay. Is comparing buyback versus dividend an equitable comparison, since buyback is restricted to 25%, 10% of share capital, but dividend decision impact 100% shareholder?
They are not. As I said, they are all both independent corporate actions.
Okay.
Apple to apple comparison nahi hai. The only thing is both are fruits, returning value, returning sweetness to the shareholders.
Okay. Ankit, in case of private limited company, if shares are not demat from before 30 September, whether buyback can still be undertaken?
Yes, it can be.
Is there any penalty provision for non-demat? Acha. We are 10 shareholder now and one shareholder 100% shares can be buyback, which is 10% stake. So after buyback, only 9 shareholder will remain for unlisted company. He's saying 10 shareholders there, one person is holding 10%. I can buy back on that person's shares only.
Sir, there are different views on this topic. If you see, the act provides that buyback has to be on proportionate basis. Many companies are doing it like that they are offering the shares to all the shareholders on a proportionate basis, and then only the one who actually whose shares are intended to be bought back applies for the shares, and also apply for additional shares because none of the other shareholder applies. It has to be only court decision can only upheld whether that can be said to be on a proportionate basis, but this is the way most of the companies do their buyback.
But if you are planning for one person, but other people have done, you have to follow that also.
Yes, definitely.
Okay. Can a company create capital redemption reserve under section 69 for a securities premium account?
From where you are
No,
doing a buyback,
it
then
is,
you have to
it
create a
is,
capital redemption reserve.
it is only in respect of the face value, nominal value, not in respect
Yes.
of the premium.
Okay. Okay. So friends, we have received more than 45 questions, and various questions I have asked myself also, and some of the questions were a big one also. So we have tried to complete. So thank you very much, all participants. In case your any question is not answered or you have missed out, please write to us. We will give answer to this. So thank you, everyone. Thank you, R.K. Agrawal ji, in absence, Sanjeev Hemawat and Mr. A.K. Jain, those who have given their valuable input. And thank you, Anjali, for giving a nice presentation. And thank you, Ankit, for covering
Thank you, sir.
listed companies
Thank
portion.
you.
So with these things, we are closing today's topic. And I hope that this program will be useful for everybody. Ankit, I have yesterday somebody has sent one question, so I missed out. Just I want to finish.
Hmm.
Section 68 provides that buyback should be 25% or less than aggregate to paid up capital and free reserve. 68 is silent on maximum number of shares which can be bought back. There is one situation in which amount involved in buyback is less than 25% of aggregate of paid up capital and free reserve, but number of shares involved in buyback is more than 25% of total share number of shares.
It is
So,
possible.
Is it possible? Okay.
Yes.
So thank you. Thank you very much. So with these things, I'm closing this today's seminar. And friends, this buyback is a future and it will continue. Anjali, you want to tell and you give the last remark?
Surplus funds in any company are not desirable at all. It's better to return the same, and if somebody has any doubts कि buyback is a complicated process or expensive process, the benefits that will be derived from a buyback would be way higher than the costs.
Okay.
So it is an investment.
Okay, Anjali, because question is still coming. Can selective buyback can be construed as a
No,
capital action?
not
And
possible.
demat dividend implication to be triggered? Okay. Okay. So, friends, Rishabh has asked, kindly explain the last question. I don't know which last question you are talking. Just write to us. We will reply to you. Okay. So, friends, as our journey of knowledge sharing will continue, and this is our 171st webinar, and we will have the next webinar on next Friday. And SEBI has come out 2 consultative paper on ease of doing business for RIT and InvIT, and the debenture convertible instruments. That program we will do it on next Friday. Till then, I take leave, and I request everybody, because this new topic is very interesting. SEBI is thinking that how to remove hurdles, how to bring out new things, and RIT and InvIT and non-convertible security. That is the questions. So we want to do it. Questions are still coming. Mr. Umesh, you write to us. We will send directly to the answer of the CRR to you. So thank you very much. Thanks everyone for participating. Thank you.